Hello, I'm Ben Verosh.
And I'm Dasha Silivanova.
And this is the Market Measure. February was a challenging month for US equities. A range of benchmark indices fell across the capitalization spectrum, with the S&P Small Cap 600 the hardest hit, down 6%, while the S&P 500 dropped 1%. US Treasuries, on the other hand, had a strong month, with the S&P US Treasury Current 10-year Index up 3%, its best monthly performance since 2023. Many international equity markets did much better than the US, with the S&P China 500 up 7% and the S&P Europe 350 up 4%. In a period when US large caps underperformed, it was little surprise to see defensive factors outperform. Low volatility was by far the best performer among our reported range of S&P 500 factor indices, rising 4.7% and outperforming the US bellwether by 6%. This was low vol's second best monthly performance versus the S&P 500 in the past 10 years. The underperformance of megacaps is threatening to be a theme of 2025. The Magnificent Seven made a negative contribution to the S&P 500 in February and year to date. However, stocks further down the capitalization range rose to the occasion. The horizontal axis of this chart shows the excess return of our range of factor indices in 2024, and the y-axis measures year-to-date 2025 excess returns. Indices in the top left quadrant, including low volatility and dividend aristocrats, turned from underperformance in 2024 to outperformance year-to-date, while those in the top right, including momentum, maintained outperformance both last year and so far in 2025. The concurrent year-to-date outperformance of momentum and low volatility has been unusual, as the two factors exhibited differentiated performance cycles in recent quarters. As this chart shows, in the 6 quarters between Q3 2023 and Q4 2024, low volatility showed opposite periods of outperformance compared to momentum. Year-to-date, however, both outperformed the S&P 500 by a wide margin.
Momentum has indeed not just outperformed in the past 3 months, but has also excelled in recent years, primarily due to its strategic approach to constituent selection. Its dynamic strategy allowed it to outperform even the largest mega caps during periods when smaller companies took the lead. In 2024, it outperformed the 500 by an impressive 21%, resulting in a cumulative lifetime excess return of 99%. Our analysis highlights that nearly 95% of its excess return was driven by successful stock selection, rather than sector weights, which contributed only marginally. Notably, just 10 companies were responsible for the majority of excess returns. Among this, familiar names like Nvidia, Microsoft, and Meta played significant roles. The S&P 500 Momentum Index undergoes a semi-annual rebalancing in March and September. The results sometimes favor larger constituents and other times tilt towards smaller ones. As of the latest data, the index slightly tilts towards smaller companies than its benchmark. For an in-depth analysis on Momentum's historical performance drivers, check out the full blog, Mum's Recipe, Sectors, Stocks and Size on the Indexology blog website. We also publish a wide range of month-end dashboards and research reports, among the most popular of which is the SPIVA Scorecards.
SPIVA stands for S&P Indices versus Active, and in the last 2 decades it has become the de facto scorekeeper of actively managed fund performances around the world. SPIVA Scorecards provide a wealth of in-depth data on active funds' performance, including underperformance rates, risk-adjusted outperformance, survivorship rates, equal-weighted returns, asset-weighted returns, quartile breakpoints, as well as analysis and commentary on the market backdrop. The S&P U.S. Scorecard, the first in our series of regional reports, was published on March 4th. In our largest and most closely watched comparison, 65% of all active large-cap U.S. equity funds underperformed the S&P 500, worse than the 60% rate observed in 2023 and slightly above the 64% average annual rate reported over the 24-year history of our SPIVA U.S. scorecards. Looking at 2024 underperformance rates in other actively managed fund categories, we find that 79% of all domestic equity funds, 62% of mid-cap funds, 69% of international equity funds, and 71% of emerging markets equity funds underperformed relevant benchmarks. Small-cap funds were a rare bright spot, as only 30% of funds lagged the S&P Small-Cap 600. Fixed income results were generally better than those in equities, with an average 1-year underperformance rate of 41% across all fund categories and majority outperformance in over 2/3 of categories. Performance among credit managers was mixed. 70% of general investment grade funds outperformed, but 66% of high yield funds underperformed. These are just some of the highlights of the 2024 SPIVA U.S. scorecard, which contains detailed statistics on a total of 38 categories, 22 in equities and 16 in fixed income. To read the full report, head over to indexologyblog.com, where SPIVA has a dedicated subpage. In addition to the US scorecard, we'll also publish reports on 8 other geographies in the coming weeks, so keep an eye out on additional insights on active fund performance around the world. At S&P Dow Jones Indices, we measure the markets.
And this was the Market Measure.